Welcome to the Deep Dive, where we take that fire hose of information and really distill it down to the shots of insight you need.
And today we are doing a really critical deep dive.
We're looking at a comprehensive 2026 investment outlook, and I have to say, looking at the sources, the environment right now is just absolutely insane.
It's a market of contradictions, isn't it? I mean,
Yeah.
you have this wild optimism just clashing with some really serious historical warnings.
So what's our mission here?
Our mission is surgical. We're extracting the precise strategy of one prominent investor.
What he's buying, what he's selling, holding.
Exactly. Across the whole spectrum, stocks, real estate, crypto, precious metals, you need a roadmap. And this strategy, it's a detailed blueprint for how to prepare.
Right, whether we're heading for a generational buying opportunity or...
A pretty painful reset.
And the context here is just everything. The contradictions are almost hard to believe.
Okay, so let's start there.
Well, take this tension point. We have more than half of Americans, 55%, saying they just don't have enough money to invest.
And yet at the same time, the stock market is just stubbornly hovering near its all-time highs.
It's a huge disconnect.
A massive disconnect. Main Street versus Wall Street right in front of us.
Exactly. And that feeling is reinforced by insiders. You have some of the wealthiest people in the world openly ringing the alarm about a potential AI bubble.
While executives are selling their own company's stock at the fastest rate we've seen since 2021.
They're taking their chips off the table.
And if you just look at the raw valuation metrics, I mean, the picture gets even clearer.
It starts.
By almost any historical measure, nearly every asset class, U.S. stocks, housing, even parts of the bond market, is trading at its most expensive price ever
in history. So
Okay.
Expensive assets, nervous insiders, an average investor who feels totally priced out. And then,
the Fed.
to top it all off, the Federal Reserve, for the first time in years, just started printing new money again.
It's a strategic minefield.
It is. And that's why following a disciplined, well-researched strategy for 2026 is so vital.
Which brings us to the first, and maybe the most surprising, pillar of this investor strategy. Stocks.
Stocks.
Which, despite all that doom and gloom, were his #1 best-performing investment of 2025.
Okay, let's unpack that because it's astonishing that stocks were the winner.
Yeah.
Especially when you look at his journey. He actually saw 7-figure losses earlier in the year, right, during that serious April dip.
He did.
So how do you recover from that and still call stocks your best asset?
It all comes back to his core philosophy. Simplicity and discipline.
Not timing the market.
Not at all. He's not trying to pick the next breakout stock. His whole strategy values set it and forget it growth. He's riding the global economic tide, not the latest news cycle.
That strategy sounds almost too simple for such a volatile time. What does that portfolio actually look like?
It's almost all dollar cost averaging, or DCA, into broad index funds. He splits his stocks across 3 main funds. A big allocation to a U.S. broad market ETF that covers the S&P 500 and mid-caps. And then he has a pretty significant chunk dedicated to global exposure.
How significant?
20% to international stocks, and then another smaller 5% to emerging markets.
Wow. So that's a full 25% outside the U.S.? A lot of investors just stick to the S&P. What's the thinking there?
The rationale is just pure diversification. I mean, he wants to be riding the entire world stock market.
Right.
The belief is that while the U.S. leads in innovation, the rest of the world will eventually, catch up to our advancements. So this way, he's guaranteed to participate no matter which country outperforms in the short term.
Okay, but this is where it gets really interesting.
Yeah.
When that simplicity was actually tested, you mentioned that April sell-off.
Yeah.
S&P below 5,000. Bitcoin got hammered. And he sees those 7-figure losses on his statement. Emotionally, that's where most people just panic.
They panic and sell.
Right.
He did the opposite. He saw it as a massive gift.
Yeah.
He had dry powder ready, and he chose to quadruple down.
4 times his normal amount.
4 times his normal monthly investment, while prices were cratering.
But how do you even fund that? I mean, how do you do a quadruple down move when you're already sitting on those kinds of losses? That takes serious cash and conviction.
It does, and it speaks to the liquidity in the rest of his portfolio, which we'll get to. But the psychological insight here is key.
Okay.
It is objectively better to buy cheaper than more expensive. He talks about how absurd it is to see Young investors, people with decades until retirement, cheering record all-time highs.
Yeah, that never makes sense.
Logically, a lower market helps them immensely. Their monthly DCA buys more shares. So when everyone else is panicking, the prepared investor buys.
And this brings up that essential point about market timing, which you just can't control.
You can't. Absolutely. He's the first to say that nobody knows when the next dip or crash is coming. You can't just wait on the sidelines.
The data is pretty clear on that.
Incredibly clear. The S&P 500 has never produced a negative result over any 20-year time frame. But if you try to outsmart it, the market can remain irrational longer than you could remain solvent.
So that DCA strategy is his shield. It protects him from that temptation to time things.
It does.
Okay, so the stock market is this chaotic black box. Where does he focus his control? It's not in timing the dip, but in minimizing leakage, his own spending.
Yes. And this is such a powerful message for you, the listener. When every asset is expensive and unpredictable, the one thing you have absolute control over is your own balance sheet.
Your personal spending.
Exactly. Taking stock of how much money is quietly leaking out every single month.
I love the story he shared about this. It wasn't some, complex financial derivative that was bleeding him cash.
No, not at all. It was simple digital subscriptions.
Right.
He realized he was unknowingly subscribed to some piece of software. It had auto-renewed, and the price had jumped 50% higher than what he originally paid.
That quiet leakage, forgotten trials, auto-renewals, it adds up.
It can add up to thousands of dollars a year. And that diligence is foundational. It provides the capital you need for those quadruple down moments we were just talking about.
That makes perfect sense. Control what you can. Okay, now let's get to the major pivot.
The big one.
The investor is completely exiting the housing market, selling off all of his investment real estate.
This is a massive shift, a huge shift, especially since he started his career back in 2008, focused heavily on real estate.
So why liquidate the entire rental portfolio now?
The decision is driven by a twin focus: financial reality and peace of mind.
Let's start with the financial angle. I mean, why abandon what so many people see as the ultimate inflation hedge, especially with the Fed printing money?
That's the classic thinking, but the math has completely changed. The ROI has fundamentally shifted.
How so?
Because of high home prices and surging mortgage rates, the monthly payments for new investment properties have more than doubled in just the last 5 years.
Wow.
In almost every part of the U.S. right now, the numbers just show it's cheaper to rent the same quality home than it is to own it.
So the whole cash flow argument is basically collapsing.
Precisely. From a purely financial, capital-efficient view, that money is now better used somewhere else.
Right.
Selling lets him cash out all that built-up equity and put it to work in assets that can generate better returns with way less hassle.
And that word hassle, that brings us to the second factor.
Peace of mind.
He's optimizing for time.
He's choosing to optimize for more time over more money. He's just explicitly tired of being a landlord.
Especially in some places.
Particularly in high-cost, high-regulation areas like California. Prices have soared, but expenses, insurance, taxes are rising faster than the rent caps let him raise the rent.
So he's done with contractors, management companies, all of it.
All of it. He's done.
That decision really underscores a powerful personal choice. I mean, prioritizing your own stability and sanity over squeezing every last dollar out of a physical asset.
And long-term, his only real estate goal is just one primary residence, a place to live.
And if we look at the broader 2026 housing outlook, this move seems pretty measured.
It does. The consensus supports it. Analysts expect mortgage rates to maybe decline a little. Prices might soften, but a full-blown collapse isn't what people are expecting.
So affordability might get a little better?
A little, but not by much. That high friction of ownership is probably going to persist.
All right, let's transition into the deep end now. High volatility assets.
Yeah.
Let's start with cryptocurrency, specifically Bitcoin, which was just the definition of extreme volatility in 2025.
It was a true roller coaster, but with a surprising end result.
Right. It started 2025 around 93,000, shot up to 125,000.
And then retreated all the way back down, settling around 90,000 by the end of the year.
So if you just bought one coin at the start of the year and held on, you actually lost money.
You lost money.
What drove that insane swing?
It was really a combination of three factors. First, just too much leverage in the system.
People borrowing to buy.
Exactly, which led to these huge cascading liquidation events when the price started to fall.
And the second factor?
A general flight to safety, capital moving away from high-risk assets during uncertain times. And third, After years of massive gains, a lot of institutions were just taking profits.
Okay, so knowing all that, how does this investor maintain his optimism?
He keeps his allocation intentionally small. Only 10 to 15% of his total portfolio is in a Bitcoin ETF.
So it's an amount he's willing to lose.
Explicitly, he says he's willing to risk it to zero. The long-term optimism is really based on one idea,
That the Fed will keep printing.
that the Fed will just continue printing more money, and people will increasingly look for a truly decentralized digital store of value.
And he also used a really clever tax strategy during one of the dips, tax loss harvesting. Can you explain that?
Yeah, this is a key technical detail. When the price dropped, he sold his large purchases at a loss. He then used that loss to offset capital gains he had somewhere else in his portfolio. The critical part is that he followed the wash sale rule.
He waited.
He waited the required 31 days before buying back into the Bitcoin ETF. This lets him keep his exposure to the asset while legally shrinking his tax bill for the year.
It's a very sophisticated move.
It is.
It shows that even in the riskiest assets, there are disciplined financial tools you can use. Now, for the mirror image, the big 2025 outperformer.
Precious metals.
An absolutely astonishing run. Gold passing 4,300 an ounce, silver hitting almost 70, platinum reaching 2,000.
The really fascinating story here, though, is silver. It's moved way beyond just being an inflation hedge.
Right, it's about industrial use now.
Its price is being driven by incredibly strong industrial fundamentals. We're talking solar panels, EV components, high-end electronics, all of that, plus the economic uncertainty, means demand is just. It's high.
And the supply side of that story is pretty powerful, too.
It is. Silver has been running at a global supply deficit for 5 straight years.
5 years?
We are using more than we are mining. And that consistent, prolonged deficit is a major game changer for its price going forward.
So if we connect that to the bigger historical picture, where does silver stand now, even after that phenomenal run?
This is a mind-boggling part. Even when you adjust for inflation, silver is still substantially below its historic 1980 peak.
Really?
To hit that same inflation-adjusted high today, silver would need to be trading somewhere between $150 and $200 an ounce.
So there's still massive room to run, potentially.
Potentially, yeah. And that's why so many investors watch that gold-to-silver ratio so closely.
Explain that for us.
It just tracks how many ounces of silver it takes to buy 1 ounce of gold. When that ratio hits an extreme, it often suggests a major correction is coming.
And right now?
It remains provocative. Because you can't just go out and create more silver. The fact that gold commands such a high multiple suggests one of them is significantly mispriced. He holds both just to maintain that exposure.
Okay, we've covered the growth engines and the big sell-off. Let's talk about the fail-safe.
The ballast.
The part of the portfolio that's dedicated to playing not to lose.
Right. This is the 20% allocation reserved purely for stability and liquidity. It's a mix of tax-free municipal bonds, or MUNs, and U.S. Treasuries. It earns a stable, guaranteed income between 3.5% to 5.3%.
And just to clarify for our listener, what exactly are tax-free MUNs? Why are they so attractive here?
Sure. So municipal bonds are basically debt issued by local and state governments. The key feature is that the interest they pay is exempt from federal income taxes, and often state taxes too. So for an investor focused on stability and tax efficiency, they're really appealing. It's reliable government-backed income that doesn't add to your tax bill.
And that 20% allocation, it's a deliberate choice. He's choosing stability over maximum return. He even admits the money probably would have done better in the S&P 500.
But the peace of mind is worth it. It ensures resilience. That segment generates monthly income, and crucially, it makes sure that if the market takes that massive fall everyone fears, he has cash ready to jump back in and quadruple down at lower prices.
The portfolio is structured for durability.
Exactly.
And connecting this to the broader market view for 2026,
Ah.
he does worry about some of the more speculative assets.
He does. He worries that AI valuations are, in his words, a bit frothy.
Too much speculation.
A little too much, yeah. But, and this is key, that concern is not stopping his consistent buying. He knows that avoiding market timing is the superior strategy, even when things feel overvalued.
So if we sum all this up, what does it mean for you, the listener, in the year ahead?
Well, the general analyst consensus, which is confirmed by this strategy, is not for an imminent collapse or, an explosion in one single asset class.
It's something different.
It is. We're probably entering a time of lower, choppier returns, a little more volatility, and fewer easy wins.
A market that's really designed to test your patience and consistency.
Absolutely. The future, according to this analysis, will reward consistency, patience, and discipline. Markets tend to punish people who chase headlines, who over-leverage or try to outsmart these incredibly sophisticated trading systems.
So the easiest way to come out ahead is the simplest.
It is. Diversify across the globe, keep buying consistently, and don't panic when things drop.
So to summarize the core lessons here for you, the listener,
Mhm.
in a market where pretty much every asset is historically expensive and uncertainty is high, the guiding principles from this strategy are consistency and diversification through index funds.
Paired with a fierce prioritization of stability.
Right, stability that shows up in two ways: selling off the hassle of real estate and allocating a full 20% to safe, income-generating treasuries and municipal bonds.
And that leads us to a final thought for you to reflect on. We saw that this investor places a heavy quantitative price on peace of mind, that 20% in treasuries. However, if we look back at precious metals, specifically silver, even after its huge run in 2025, it's still so far below its inflation-adjusted 1980 peak. That suggests a potential long-term price target of maybe $150 to $200.
So the question is,
The question we'll leave you with is this: are investors prioritizing stability too highly? Are they potentially leaving significant long-term growth on the table in foundational, non-creatable assets like precious metals? That's something to mull over as you build your own strategy for the year ahead.